Hi, this is Michael Fisher for SavingAndInvesting.com, and I want to talk briefly about central banks and monetary policy. Monetary policy is one of the main economic policy items that's used to keep inflation in check and also, in many cases, to ensure stable and steady growth in an economy. Now, how does this work? By controlling the supply of money and the availability of money and the cost of money, central banks, typically in Western economies, can influence to what extent companies can borrow, how much money there is in circulation, what the cost in some cases for short-term borrowing is, and this all in turn can affect, or is targeted to affect, the rate of inflation and to some extent ensure steady growth. For example, the central banks are often typically involved in setting short-term interest rates at which other banks borrow at. And this means by setting this interest rate higher or lower, it influences the interest rate within the economy overall. And if these banks can borrow at lower rates and lend at lower rates, it means that it's easier for companies ultimately to borrow and to fund growth. Central banks can also affect the amount of money in circulation, the amount of currency in circulation, by buying government debt, secondary government debt, or debt instruments. And by doing so, they're basically putting cash back into the economy, creating a greater cash pool in effect that then circulates, and that way stimulating the economy and creating to some extent inflationary pressure or growth pressures as well. By selling secondary government debt, by selling bonds, for example, into the market, and investors buying these, currency comes out of circulation, and thereby the central bank can reduce the amount of money in circulation and reduce inflationary pressure by limiting the amount of cash that's in circulation. So monetary policy is one of the key tools that's used under the umbrella of economic policy to control inflation and to affect the growth of an economy. And the monetary policy is the policy that relates to money in circulation, interest rates, particularly short-term interest rates, which central banks can set, particularly for other wholesalers and government and bank institutions. And it is those policy decisions that central banks take that are targeted at keeping the inflation in check and also contributing to slow and steady growth in an economy, a measured growth and an adequate growth.